Hello everyone. I hope everybody is fine. So as you know, in the recent past, we have been discussing about the RBI Grade B District Examination, and multiple topics have already been covered up through my previous videos. And those topics were primarily on the growth and development relating to the economic and social issues of our country. So in line with the same discussion today, I am going to have a discussion on a very significant topic, and that is the Indian economy with specific reference to the monetary and fiscal policy post-reforms 1991. So for that, we have to know what exactly were the 91 reforms all about. So let me tell you that in the prior to 1991, the era was conveniently, it was called the era of the license permit Raj, or the control era, wherein a lot of impositions were done from the government side, and it has to be abided by the private entrepreneurs or businessmen or the financial institutions, or for that matter, anybody and everybody that were associated with all these kind of functionalities. So came 1991, and it was in fact an inflection point in the Indian economy, wherein a large number of reforms were taken up. Liberalization was one of the part. Multiple benefits were given to all these institutions and the people who were actually involved in the business activities. They were left to their own decisions. The controls were minimized, and even a large number of the unwanted or additional rules and regulations, they were removed. So the 1991 reforms were taken up by the then Finance Minister Dr. Manmohan Singh. He was of the opinion that unless and until you liberalize the whole economy, you're not going to go for economic development in the long run. And in fact, this has faced the benefits. We are reaping the benefits. In the recent past, almost 31 years have gone by, and the result is for everyone to see. This is not to say that these reforms have given the exact outcomes, but definitely we are much ahead of the pre-91 situation. So I am Professor P.K. Pathak, and I am going to have a detailed discussion of the monetary and fiscal policy reforms post-1991, and what was the correlation between the monetary and fiscal policy before 91, what is the correlation after 1991, what impact it has in terms of the economic development, and what are the limitations, what else we can do. All these related topics we are going to have a discussion in the following few minutes. So it is my urge to all of you that do stick to my video till the last point, and try to make a note of all the important one-liners, so that whenever you need to press yourself, you have a ready revision topic available with you. So before I proceed with my discussion, I urge all of you to do like, share, comment, and subscribe to the YouTube channel, and keep on receiving similar and significant videos on various topics. And let me tell you, although this has been tailor-made for the people who are preparing for the RBI Grade B District Examination, these topics are equally important for the students or the MBS or the BBS, and because these are inherent part of their academic curriculum as well. So irrespective of which domain you are studying in, whether in the field of management or in the banking or in the general awareness, all these topics are going to be very useful to you in your professional and personal life as well. So on this note, now I am going to share my slide, and after that we will have the point of discussion on everything that we have just quoted right now. I hope you can see the slide. So as I was telling you, this is the topic of the day: the Indian economy with specific reference to the monetary and fiscal policies since the reforms of 1991, and tailor-made for the RBI Grade B District Examination, but equally applicable to all other MBAs and different other students. So what is the monetary policy reform? You can see the monetary policy of RBI has undergone massive changes during the economic reform period, And let me tell you that monetary policy is basically monitored by the RBI, while the fiscal policy is a function of the central government. Okay, so that's a basic difference you must know. So what was happening was, prior to 1991, both were interrelated or correlated by way of, all the fiscal deficits, they were supplemented by the monetary policy of the RBI. But came 1991, and the monetary policy is now dissociated from the fiscal policy, thereby by releasing the RBI of having the obligation to fulfill all the fiscal deficits of it all. So what was the emphasis that was given to was to for the stable macroeconomic situation and the low inflation policy. So this paved the way for an overall judgment of the whole country and how we can bring down the inflation while continuing with the normal business activities. That was the point in agenda. So let us proceed and let us identify the relation between the monetary policy and the fiscal policy. Because, in spite of the fact that they have been separated, they cannot exactly be framed independently. Okay, so they have to be correlated in one way or the other. And keeping that in mind, RBI has often adopted a commodity monetary policy to the government's fiscal policy, because ultimately the aim of both of them is achieving growth with their price stability. So let us now know what was the pre-91 scenario. Okay, so as I was telling you, the economic before the initiation of the economic reform, the basic goal of the monetary policy was to neutralize the impact of large fiscal deficit of the government. So let me tell you, the government has to do all kind of expenditure for the growth of the country and for the welfare of the people. But since there is no income for the government, it collects various kind of tax, and out of those collections, whatever is revenue generated by the government, it is being spent for the public welfare and infrastructure development, apart from other activities that are required to be done in normal course of time. But more often than not, it happens to be quite deficit. So whatever is the revenue, the expenditure always goes higher than that. So this is what we know as the fiscal deficit. When you have a budget more than your revenue, the deficit will occur, and that is what is known as fiscal deficit. Now the government is bound to complement whatever planning it has made, and so therefore, from where to fulfill the budget fiscal deficit, the government has got two specific ways, and these are either borrowing from the market or deficit financing. So when you borrow from the market, maybe internal borrowing, maybe external borrowing, it will lead to inflation because more money is in circulation in the market. At the same time, even when the deficit financing takes place, which definitely means whatever is the deficit with you, you have to print currency notes. So, but in the process, again, as you must be knowing the concept of the inflation, for the same value, backup value, if you have more number of notes, the value of the per unit number of note is going to be down, and so therefore inflation will occur. So irrespective of what follows, you have an inflation, higher amount of inflation, and this cannot be cut because there is a large increase in the government expenditure and the various 5 years plans that were financed by the borrowing of the government of the deficit financing. So what was made prior to 90? I'm talking about the prior to 90. So in order to ensure adequate funds to meet the borrowing requirements of the government, the statutory liquidity ratio of the banks was raised to the maximum limit of 38.5%. So you must know what is statutory liquidity ratio. It is the amount or the percentage of the money that the commercial bank has to keep with them in the form of the liquid cash or the security. Okay, so whatever is their demand and time liability in terms of the deposit. So, for example, if I have to say that suppose 100 crores are being deposited in a particular bank, so what it can do is it can only dispense 61.5 crores to the public for their business activities, while 38.5 crore rupees it has to keep as a liquid money. Okay. So this liquid money can only be utilized to buy the government security, which ultimately goes to the government. So this is how without having impact on the inflation directly, the government was able to, finance its deficit. Okay, so this was one. The next thing was the in order to check the inflation, the cash reserve ratio of the banks was raised to a high level of 15%. So, what is cash reserve ratio? It is the reserve, that amount of money that has to be kept with the RBI by the commercial bank. Okay, so in this particular case, 15% of all the deposits. So suppose 100 rupees has been deposited in a bank, 15 rupees is to be kept with the RBI, and RBI is not going to give any interest for that. So it was an interest-less amount that has to be kept with RBI. The commercial bank has got no control over it. So in this way, what happened is large extension of credit for private sector was prevented. You see, both the cash reserve ratio and the SLR, what it does, it leaves less money in the hands of the commercial banks. So when they are left with less money, the less money will go to the businessmen or the private sector, and so therefore their business expansion is also largely affected negatively. Okay, so the fixation of the CRR and SLR at their maximum level crowded out the credit for the commercial sector. So, in spite of the fact that when money supply was growing at a rapid rate, the private sector could not get the needed credit for financing the industry and trade, and therefore it was largely impacting on the overall national economic development. That was the scenario before 1991. Now, with the advent of the economic policy changes, what major changes took place? And let us discuss it one by one. Reduced reserve requirement, the very first point, and you can see during the 1991, the CRR was highest, as I have previously discussed, plus an additional CRR of 10% also was levied. But now it is reduced by 4%, so thereby enabling the banks to have more money with them for dispensing it to the private individuals. Similarly, the statutory liquidity ratio has been reduced from 38.5% to a minimum of 25%. So thereby, again, leaving a lot of money with the banks to dispense to the private people. That was the first reform that was taken. The next one was increased microfinance. So at the bottommost level, and in order to strengthen the rural finance, what it does, it created the self-help groups. So this group was a group of the common people, the farmers, the artisans, the various other, small businessmen who did not have, much access to many facilities. So what they did is they formed the self-help groups and they started helping each other, and thereby creating a win-win situation in the process. Then what was the next change? Let us see. Fiscal monetary separation, as I already have told you that in 1994, the RBI stopped financing the deficit in the government budget. So RBI has got no obligation now with the separation of the monetary from the fiscal policy to finance the budget deficit of the government. Okay. Then the next change was the change in interest rate structure. Before that, it was an administrative rate of interest. So it was fixed kind of rate of interest, and it was giving huge burden on the commercial banks, very high rate of interest being given for all kind of borrowings. And so therefore, after the reforms, it was made more flexible, and the banks could, decide to some extent within the limited framework about their own functionality, and they could make decisions according to the market. Another major change was in accordance with the external reforms. So lifting various controls on the imports and reduced tariffs, etc. And the impact was all to see the liberal inflow of the foreign policy and its implication on the domestic money supply was quite huge, and it was on the positive side, of course. And next implication was the higher market orientation for the banking. As you can see, the banking sector got more autonomy and the operational flexibility with the reduction in the CRR and the SLR. This left more money in the hands of the banks, and they became more flexible. They had got freedom for the method of processing the working funds and other functionality, and it has assured the market orientation in the long term. But in spite of all these things, there happen to be certain limitations in the monetary policy of India, and that you can see point-wise, like failed in tackling the budgetary deficit, because the budget deficit continues to grow every year, year after the year, and in some cases, some automatic monetization also takes place. I mean, printing of the currency notes, and this is giving rise to the inflation. So it was not fully able to tackle the budgetary deficit per se, if I can say that. At limited coverage, because it only covers the commercial banking system and does not have any control over the non-banking institutions. So it's indeed is having a limited coverage. Then in our country, unorganized money market is also quite huge, and the RBI does not have any control over that. So in this case also, the monetary policy had not had any impact. Predominance of the cash transaction. Before, of course, now the things are changing, but there was a research before the corona pandemic situation, and it was revealed that 78% of all the monetary transaction, the people depended on the ATMs, that means the hard cash or the currency notes. But of course, in the recent past, the digital transaction has taken place so much so that the dependency of on ATMs has reduced from 78% to anything between 16 to 25%, and the trend is again reducing trend. So therefore, we may say that the things are improving now, and even it will improve further. So digital payments are going to be the order of the day, and on this front, I mean, we are comparatively more comfortable. Then the next is increased volatility, because we have changes, made some changes in accordance with the import and export policies, and since these are depending on the foreign situation, it also could lead to a high amount of the volatility. So these are some of the limitations. Let us have certain discussion on the global financial crisis of 2008 also. What happened in the 2008 and how we got through it. You can see, or you can remember 2008 and 9, accommodative nature of the monetary policy, the government fiscal policy was there. But in October 2008, global financial crisis happened. And this was primarily because of the bankruptcy of the Lehman Brothers in the US. Because of this global financial crisis, our exports were largely influenced, and also led to capital outflows from the Indian economy. So all the foreign companies, they started taking out their capital out to their own countries. Ultimately, what happened was Indian economy started going down, started depreciating, and Indian stock market crashed like never before. So what was the ultimate result? The industrial and overall growth of the Indian economy started declining. So how we tackled it? These were some of the measures. The government increased its expenditure, especially on the infrastructural project, and cut the indirect taxes such as excise duty and service tax. So this boosted of the private sector investment and expenditure. So on these two fronts, when the private sector investment was going up, it was generating some employment for the people, common people. As the same thing with the infrastructural project, with the inflow of the money in various projects, it was a boost directly and indirectly as well on the manufacturers of the various building materials and for the people in general, in terms of the labor force. So the business activity grew, and to supplement and accommodate the government expansionary policy, the RBI reversed its earlier tight monetary policy, and to boost the private sector investment, reduced the repo rate from 9% in July 8 to 7.5% in October 2008. So what is the repo rate? Repo rate is the rate which is being charged by the commercial banks, by the RBI from the commercial banks. So when reducing the interest means more money in the hands of commercial banks. Similarly, 4.75% it was further reduced to 4.75% in March 2009. RBI reduced CRR from 9% to 6.5% and further to 5% in March 2009. So again, it made available the more funds to the banks to buy government securities, and also to prevent private sector from spending the investment. That thus we can say that RBI monetary policy has been accommodative in the sense that it provided support to the government fiscal stimulus package. However, in the later half of 2009 and 10, when the inflation rate started going up, the RBI started withdrawing from the accommodative monetary policy and started tightening its monetary policy to fight the inflation. So it's all a sequential process. One thing leads to other, and in order to curb that, you have to adopt certain policies and so on and so forth, and the cycle goes on like that. So that's all for the day. I hope you must have understood what the monetary policy, how it was changed to suit our economic development and other conditions, and how it has largely impacted on the overall economic development of the country. Okay, so in the next video, I'll be coming out with the fiscal policy, which was left undiscussed. So tomorrow we are going to have a discussion on the fiscal policy. So till then, stay tuned, and I thank very much for sticking to and focused to my video. Definitely, I'm sure that you'll be getting a lot of advantage through these discussions, and in case you can make certain points, you are going to be more beneficial in the long run. So on that note, my best wishes to all of you for your forthcoming endeavors, and do like, share, comment, and subscribe to my YouTube channel. You can get in touch with me to my email ID. You can suggest me in case you require certain more topics to be discussed at length. Okay, so on this note, I stop for the day, and again wish you all the best, and hope you will be doing well in your all forthcoming endeavors. And thanks for being so courteous and watching me till the end. Have a good day.